Hi there, so today I just want to give you a quick update on some of the shares that I've invested in just this week. I've got one of them is absolute stonker in my opinion. I think it's potentially got the potential to triple its value within the next 3 to 5 years, so I'm quite happy with that. All three of these are REITs, so that means the underlying investment is property. All three of them pay dividends monthly, and all three of them are super high dividend shares. So you're going to get a nice high income if you choose to copy me and invest in these shares. Of course, that's entirely up to you. If you're new to this channel, welcome. My name's Andy, and on this channel, I speak about money and success. If you're interested in either of those two topics, please be sure to hit the subscribe button down below, hit the notification bell, and then you get a notification every time I release a video. If you enjoy this kind of content, please do give it a thumbs up. That really helps the YouTube algorithm, so I'm told. And obviously that helps me in turn, so I'd appreciate that too. Before we get started, I just need to say I'm not a financial advisor, so this is not a financial advice. I'm literally sharing with you some of the shares that I've invested in myself this week. I'll tell you how much I invest, I'll tell you what I expect the shares to go to, but bear in mind I'm not a financial advisor, so you need to do your own due diligence, do your own research, and make your own decisions before you make any investments yourself. With all that said, let's dive right in. The three shares. The first one is Stag. You've probably heard of that. Stag is a REIT, which means real estate investment trust, and Stag generally invests in industrial properties like distribution centers, warehouses, things like that. The next one is Main Street Capital is actually an ETF which invests in property as well, so it's a similar kind of thing. Both of these have got super high dividends, as you can see. Stag is a 5.1% dividend, Main is a 7.29% dividend, so they're both very good. As you can see, I'm expecting quite high returns on both of those. So on Stag, I'm expecting 41 to 51% return, and on Main Street Capital, I'm expecting 66 to 81% return. This is over a 3 to 5 year period, bear in mind, folks. I'm not expecting this to happen next week. In the next 3 to 5 years, that's when I'm expecting them returns. Now, you notice I've put question marks next to the final one, so you don't know what it is, because you've got to keep watching to find out, but I'm going to get right to it in a moment, okay? So the third one, as you can see, 170 to 195% return, which basically means I'm expecting in 3 to 5 years to pretty much triple my money on this, which I think is great. So you'll see in the example, I've put $1,000 as if I've invested $1,000 per one. That's not actually what I've invested. I've actually invested more than that in all three of these, particularly in the last one, because I think it's so good myself. I've just used that $1,000 example because I think it makes it nice and clear so you can see what I'm expecting the returns to actually be on this. And bear in mind, these returns that I'm expecting are over the next 3 to 5 years. So the final one, it's a REIT. It pays dividends monthly. As you can see, it pays a 12.49% dividend. Stag, the first one, I bought that at $26.59 per share. Main, I bought that at $31.10 per share. And the third one, it's EPR, and I bought that for $35 per share. Now, who are EPR? I can hear you asking now. Let's have a look at EPR. Their growth, as you can see, has been absolutely phenomenal. Since 1997, they've made 1,762% return for investors, which is absolutely killing, as you can see, the indexes that they've compared themselves to. So I do think very, very good. They've got growing investments, you can see on this chart here, and the kind of things that they invest in are recreational facilities. So they've got golfing experiences, things like that, ski resorts. So the kind of things that they're investing in are all closed right now, which is why this share value is right on its knees and why it represents such a good opportunity to buy right now. Because when things open up again, my view is it will go back up again. And let's have a little look at some of the numbers, because I know some of you may have some concerns, and I'll explain to you how I've satisfied myself at least, so that you can get an underlying feeling as to my thoughts. But of course, you do need to do your own research. Numbers wise, you'll see you've got this 12.49% dividend. You've got an annual payout of $4.59. And the payout ratio, you'll see, it says 139.92%. Now, ordinarily, that would ring alarm bells and I wouldn't touch it. Quite frankly, anything with over 100%, it's not going to be sustainable, you would think. However, what I have done is I have had a look at the free cash flow. And if you look at the free cash flow, well, I'll come to that. I'm going to come to that in a minute. Let me come to that in a minute, okay? As you can see, they've been growing the dividend year on year, and they've got 10 years of dividend growth. And if we click dividend history, you can see it's growing quite nicely. It had a drop off, and my view is that they've basically become more cautious since then. So something obviously went wrong then. They dropped it down, and they've been growing it up ever since. and every year it goes up, and that's good. And it's paid monthly, which is even more good as far as I'm concerned. If we have a look at the balance sheet, you can see the assets have been increasing. If we look at the total assets, you can see they've been increasing, almost doubled actually in 5 years, which is obviously very, very good. The liabilities have gone up, but it's in proportion, so that's absolutely fine. And if we look at the cash flow, and this is the key thing now, okay? Look at the free cash flow per share. So the key cash flow per share is $5.23. Now, if you remember, that dividend is only $4 and something. And this is a very important metric to look at. And it's actually, I believe, more important than your regular payout ratio, because this shows you truly what the company can afford to pay. So I have calculated that. And if we go back to my spreadsheet here, we can see that the free cash flow payout ratio is actually 82%, basically. So they're using 82% of their free cash flow to pay the dividends at the moment. So they're fine. There's not a problem. Furthermore, on the balance sheet, they actually have plenty of cash. I'm not going to go back to it now, but they have plenty of cash on the balance sheet. So they've got more than enough cash to pay, even if they had no income coming in. Bear in mind, even though the facilities are closed down, these are the landlords. They own the facilities, so they're still getting rent. Sure, some of the rent will have been stopped. I'm sure there'll be certain companies that are not able to pay the rent, but they're not like the cinema themselves that's closed. They own the buildings. So they're still getting rent just fine, mostly, as far as I can see, according to the information they've put out anyway. As you can see here, their 52-week high is $79.85. The 52-week low was $12.56 per share. Don't you wish you bought them then? The current share price is $34.33. It's actually not. It's gone up since then. That's when this sheet is when I was researching it before I actually did it. Actually, I've just cut that down. So the actual share price at the moment is a little bit more than I bought it for, I believe, which was $35 I bought it for. The dividend yield is 12.49%. The payout ratio from free cash flow is 82%, which I'm quite comfortable with, despite the overall payout ratio showing as 139%. And its assets to liabilities ratio is absolutely fine. So let's have a look at my prediction. Here's my prediction. So we've got a current annual dividend of $4.59. If you remember, it was $5 and some of free cash flow, hence the 82% thing. The potential gain, once it gets back to the 52-week high, is 132%. So that's capital gain, that's the inflation in the price. In the event that I invested $1,000 and it gets back to its 52-week high, the gain would be, not the price, the gain would be $1,325.95. The annual dividends are $124.90. So assuming it takes 5 years to get back to that original high, 5 years to get back there, and it'll probably go past it, but let's assume it takes 5 years to get back to where it was, then a $1,000 investment will be worth $2,950.45, including the dividends added in, which is 195% gain, or almost triple your money. And boom, there you go, we've done it. I hope you like this. I hope you found it useful. If you did, please give me a thumbs up. So I hope you found that helpful. I hope you found it interesting. Be sure to subscribe for more videos like this. If you like this video, please do give it a thumbs up. I'd appreciate that. And yeah, check out my previous videos. Take care. Bye-bye.